So I was reading today on Charles Hugh Smith's column on GDP is bogus, here's why. And he makes the point that the GDP number that everybody knows and loves is basically an income number, which it is. It's government spending, private investment, saving, um, exports minus imports. So it's a current number. What it doesn't address is the national balance sheet, and he talks about like Hurricane Harvey and Hurricane Irma and Hurricane Maria, and how those damages to structures negatively impact the wealth of everybody taken as a whole, aggregated together, and that kind of got me thinking. While that's true, how important is that? Because he doesn't put up any numbers. He just shows a chart of GDP. It says, well, are you 86% better off than you were in 1980 or 19% better off than in 2000? And, you might say yes, you might say no. And, but, what are the numbers? So I went to the St. Louis Fed and, their FRED system, which is the economic research graphing thing. Anytime you see these graphs, they come from this system where it aggregates all the data from various government entities, and then you can plot things and do all kinds of fun stuff. So what I did was I took the series for household and nonprofit organizations net worth, and if you look at that, it goes way up. But you have to look at things in real terms. So I divided that by the consumer price index for all urban consumers, all items. So it's a pretty broad measure of inflation. It's not, you can argue over whatever level of inflation you want. Another series to compare might be just the M2 supply in the economy. And in fact, I think I'll do that next. And that actually gives us a really different picture. But first, to finish on this one, so we've got some measure of real net worth, and as always, you can argue as to how do they measure net worth, what are the collection methods, and all those kinds of things, and you should look at those. But just kind of as a broad picture, we can see some interesting things. So going back to 1955 or so, the line goes up and down. There's definitely some fluctuations, and there's kind of a very low exponential curve that seems to fit. But then here we've got these aberrations, and these are the bubbles. So this is the tech bubble in the stock market, which was sizable, but it didn't wreck the economy so much. So I don't know, for those of you who lived through it, people were upset, but it was not economy shaking as a whole. And then here we have the real estate bubble. So all the money from that kind of went into this, plus additional leverage because you can leverage real estate a lot more. Bubble grew larger. I wish I could turn this label off. And you can see that the deviation from the trend line was much larger. And then that bubble crashed, and we all know what happened there. And the economy almost went under. Real unemployment was 20-something%, and we're still living in the aftermath of that even 10 years later. So now this measure, this bubble that we're in now, is some people call it the all things bubble because stock market's high, bond market's high, real estate's back up to where it was. So will that crash? When will it crash? These are all questions that we don't know the answer to. But the people who are saying it's like, oh no, this is just real growth, I think we can clearly say that that is not the case. Everything is leveraged to the hilt because these numbers, include those stock market prices, the bond prices, the real estate prices, and on top of just people's savings and ownership of stuff, cars and clothes and golf clubs and whatever else. So this, I think we can pretty safely say, is a financialization bubble, pretty similar to the last two, but it's much larger. So what will it look like when that reverts back to trend? I don't know, but it's not going to be terribly pretty. So personally, that's why I'm not I'm not going into the markets and buying so much right now, because you always need buying power at the bottom. You know, back in this crash here, I was fortunate enough to have bought my house, my personal house, right around here. So, we bought it for, I don't know, $85,000, and now it's, on paper anyways, worth 300,000. So that's great. But in our market anyway, the market's already slowing down. There's a house for sale down the street from me, a couple doors, and they're asking 280, and it's smaller than my house. It's got less bedrooms and all that. Um, but it's been on the market for a while. Properties were being snapped up left and right, and now they're starting to sit a little bit. So I think we're starting to see, at least in the real estate market, a change in trend. Now, if we compare the same household net worth to the M2 money stock, it's pretty interesting. So, you know, if you take an Austrian view, the money stock is a probably a better measure of inflation. And M2, why do they stop measuring M3? Because they couldn't afford to to make the measurements. And here, at least going back to the early 1980s, this is a much different picture. So here's dot-com bubble, here's real estate bubble, and this one has less. So, why is that? And I think that bears some investigation, because if this were the same kind of bubble, we would see the same kind of hump right here. But we don't see that. We see this much smaller hump. So, you know, is that because the M2 does not take into account the leverage and things that can be done in the stock market? I don't know. It bears investigation, though. So, that would be somewhat of a counterfactual. But anyway, I just found that interesting, so thought, you might appreciate a perspective there. Anyway, hope that helps. Catch you later.